This is the first part of a three-part series on a seminar for first-time home buyers. As you know, buying a home is a big step. Choose a home and a finance program that is right for you. Looking into various mortgage options, selecting a loan program that fits your budget, lifestyle, and goals. Most folks want to know, why would I buy instead of rent? Well, a couple of important things are to remember: that buying a home is a wise investment for many people. Typically, homes increase in value over a period of time. And also, you build ownership value in the home, commonly known as equity. And interest paid on your home mortgage loan is typically tax deductible. And of course, talk to your tax consultant in reference to how that would work for you. How do I get started? Well, it's pretty easy. First of all, you should get a mortgage pre-approval. Then put together your own personal home team of experts, an experienced real estate professional or builder, and a knowledgeable loan officer. Learn more about the home buying process, and that's one of the reasons we have this seminar and other tools that are available on our website for you to be able to gather some of that information. Let's talk a little bit about the basics of getting started. How much home can I afford is a question that everybody wants to know. To determine your maximum mortgage amount, most lenders look at the following things: your credit history, or how well you've paid your bills, how much money you have available for down payment and closing costs, your income, and your existing debt and financial obligations. Your maximum mortgage amount plus your down payment equals the amount of home you can purchase. How important is my credit? Well, a history of paying your payments on time indicates the likelihood of you to continue and make your mortgage payments on time. Your credit score, also known as FICO score, can be a factor that will determine which mortgage program you would qualify for. Your credit history also can affect how much down payment you're going to need and how much money you can borrow in relation to your income. Also, it can affect the interest rate that is offered. If you don't have a copy of your credit report already, it is important for you to obtain a copy of that credit report. To establish or improve your credit ratings, there are several things that you could consider. Use credit to purchase small, low-priced items. Make a few prompt minimum payments, then pay off the balance in full. Also collect alternative credit records such as rent or utility payments. Gather up the rents or the receipts and cancel checks for those. Try to pay off any outstanding loans or credit cards that you might have. Consider closing some credit card accounts. But if you have no established credit history or less than perfect credit, there still may be loan programs that can help you buy a home. How much money are you going to need for a down payment? Today, there are many flexible mortgage programs that can make the down payment a little less challenging. You may be able to buy a home with very, very low or no down payment at all. Loans with down payments of less than 20% require what is called mortgage insurance. And most programs also require that you have 1 to 2 months of loan payments available in reserve after the closing of your loan. Closing costs. Generally, closing costs equal somewhere between 3 to 7% of the home's purchase price. Prepaid items are items that are collected at closing to cover future real estate taxes, interest, and your homeowner's insurance. Most loan programs also allow you to finance some or all of your other closing costs. Many programs also allow partial closing costs to be paid by the seller of the home or from other sources. How large of a loan can I be approved for? Lenders normally use what is called a debt-to-income ratio to determine the loan amount which you would qualify for. Typically, the anticipated house payment is compared to your total earnings or gross earnings and the amount of debt that you may have. Many programs offer expanded guidelines that qualify many people for higher loan amounts. Once you know what your maximum loan amount is, then it's up to you to decide if you're comfortable with that size of payment. You never have to spend as much as what you would qualify for. What does my mortgage payment include? Usually it consists of 4 items: principal, interest, property taxes, and homeowner's insurance. Some funds are held in escrow, in an escrow account for the paying of your future taxes and insurance bills when they come due.